Hi, this is Kofi Apia with 3 steps to making money with IPOs. In August 2004, internet heavyweight Google came into the stock market priced at $85 as an initial public offering, or IPO. In the 5th week of trading, the stock broke out of its first price consolidation. Now from there, in less than 2 months, it climbed over 75%. So it's obvious that buying the right IPO at the right time can really supercharge your portfolio. Now, Google is a rare example, and IPOs can be volatile and risky. So having some practical guidelines can really help you. So let's take a look at 3 steps to making money with IPOs. Step 1. Be sure to target companies with strong sales and earnings. Quarterly earnings and sales should be up 25% or more, or at least accelerating the last 3 quarters, because that's what winners typically show prior to their biggest price moves. Step 2. Wait for the stock's first base and consider buying when it breaks out. This should be during a market uptrend. An IPO's first base can be shorter than a standard base and does not have to have a prior run-up in price, but you still want to identify support and resistance levels before you commit your hard-earned money. Now let's see how these first 2 guidelines could have helped investors in 2012. Facebook was a highly anticipated IPO. However, the Q1 results released ahead of the IPO showed earnings growth for the last 2 quarters were below the 25% minimum you want. And the growth rate had been slowing for several quarters, not accelerating. So it did not meet your first requirement, a stock with strong sales and earnings. On the first day of trading, Facebook's initial price was $38. Over the next 4 months, the stock mostly declined, dropping below $20. Facebook did not break out of a price consolidation, so your second buy requirement was not met either. Once you buy an IPO, make sure you get out at the right time. Step 3. Apply standard sell rules. Some of them are listed here. For more sell rules, see Chapter 11 of How to Make Money in Stocks by IBD founder William O'Neill. March 2012, NationStar Mortgage entered the stock market as an IPO priced at $14. Earnings growth had been rocky in the past, but the quarter before the IPO showed signs of a turnaround. Since quarterly growth was above 25%, the stock met your first requirement. NationStar followed up with another excellent rise in sales and earnings. Now let's take a look at the chart to see if it met our second requirement. NationStar showed sideways action, forming a flat base. The stock successfully broke out in the 11th week, so it did meet our second requirement of breaking out of a price consolidation, doubling in price in under 4 months. So remember these 3 steps. Be sure to target companies with strong sales and earnings, wait for the first base, consider buying when the stock breaks out, and then apply standard sell rules. And that's your IBD tip on making money with IPOs. Thanks for watching.